Good morning, everybody, or excuse me, good evening. This is Jeff Scott, and welcome to this weekend's market review. I'd hoped to do it earlier today, but started watching football, and sometimes I just get lost watching the games. My contact information, as always, is sitting on this PowerPoint, and I respond to emails. The disclaimer that everybody gives you is educational purposes only. Any recommendations are in the spirit of education, not to be considered investment advice. I'm a doctor, not a broker. Most physicians lose money with their investments, so take that with a grain of salt. And I'm not affiliated with any software companies. Any products that I demonstrate are products that I own, and I use in my daily trading, and I paid for all the tools that I will be showing you. If I was to have to give up most of my programs because I, for example, got stranded on a desert isle with high-speed internet, not that that probably exists, I need a trading program. You'll see me on these webinars bounce between TradeStation and thinkorswim. I'm committed to both. I've spent a lot of money on customized programming on TradeStation. I've gotten increasingly interested in thinkorswim. I can see a day when thinkorswim dominates, but right now there's things I can't yet do in TOS. I use highgrowstockinvestor.com for most of my after hours, end of day, and weekend chart reviews. And it's a great scanning program, fast, and has some proprietary indicators that I've had the opportunity to participate in some of their development. I use EdgeRater or ETF Bandit, two programs from EdgeRater.com, and Chris White. He's done a recent update to EdgeRater, and next week I plan on showing you how I use it at the end of the day to run searches, updating my charts, say at 3:30 in the afternoon, and looking for, instead of waiting to end of day and then making some purchases at the end of the day before the open, trying to avoid gap ups. Now, obviously, in a trending market, that makes a lot more sense than in a news-driven one that we live on currently. But you can certainly get an idea of where the action is and don't have to wait to end of day on some of these programs. I'm a big fan of seasonal analysis. Now, I use seasonal analysis not as my primary tool, but rather as a tool to help me identify a, let's just say a pond stocked with stocks that, that's no pun intended, stocked with fish, meaning stocks that are primed to go in the direction that I want to be trading in. And I'm a big top-down guy, which means the market's going to do most of what I want, of what's going to influence my stock. The sector is going to be second, and my actual stock's only be 20 or 30%. So if I believe that, then seasonals, although important, I'm still very much depending on what the market does. Now, the interesting thing is the market and the sectors are seasonal too. So hence, I am very interested in seasonals. And Woodward and Brown, I'll mention Ian and Ron throughout my discussion. They do a lot of things that help me from the Ian's and Ron's monthly newsletter, Ron's occasional now weekend review at no cost on the website, which I'll point out, Ron's for-a-fee daily market updates, which I subscribe to, and also the blog have provided a lot of value to me over the years. Each of us have our own style. I have probably, and sometimes it makes me crazy, but I have different accounts that do different things. I have certain things that are pretty ripe with profits I've held a long time, things like Celgene, Catamaran, which used to be called Systems of Excellence or Software of Excellence. SCXI became CTRX, which is a pharmacy benefits manager. And these I don't treat like investments as much as, well, as trades as I do as investments. So I'm less likely to be in and out of them. In the old days, maybe I would have called them mattress stuffers. But most of my trading is swing trading. I have a day job, so I don't do a lot of day trading unless my swing trades turn sour pretty quickly. And my influences are really up here. O'Neill really teaching me the basics of how to buy growth stocks through Scan Slim, Morales and Catcher, taking it to another level with their pocket pivots. Bigelow, one of the gurus of candlestick, to me, one of the easier gurus to understand and to listen to. Pascal is one of many, not many, of several folks that I've become interested in who look at what institutional volume is doing. Alexander Elder, a Russian psychologist that came to the U.S., who has written what I thought would be psychobabble, but they're actually fantastic investing books, and good reads, and a lot of good stuff, such as Force Index, which we'll use tonight. Van Tharp, the king of position sizing and money management. Ronald Bronke, different than everybody else in that it is a whole different style. It's more for the, that retired person who, or anybody that isn't really going to make it on the 0.5% they're going to get on a CD if they're lucky, that's looking to generate 10% maybe 2 or 3 times a year from their investments, using covered calls and naked puts in a very safe way. Really a good read, especially if you're looking at trying to develop income. And then I mentioned Ian and Ron, who have been very important influences on me. Now I say buy, I'm interested in buy, I'm interested in buy, I'm interested in sell. That's meaningless. I have no idea what the market's going to do on Monday. So I'm going to find stocks that I'm going to put on a list that I'm going to watch during the day, and then I'll do scans during the day to see if anything else becomes interesting. So if I say it's a buy, it means that if the market is going the way that I think, and that I'm looking at the stocks, if I'm long and that's a good market, then that's good. If the sector that my stock is going in is going the right way, then I might buy that stock or sell based upon the movement of the market in the sector. So I'm going to look for specific setups that are going to tell me what to buy and sell, and that's what we're going to do tonight. I'm going to look at multiple time frames, and I'm going to look for triggers that tell me when to pull the trigger, so to speak, and buy or sell. And I get some of these automated in TradeStation and Thinkorswim using indicators from, as you can see, Market Gauge, Never Lost Trading, and others. So if I say it goes on my buy list, all it means is I'm looking at it tomorrow, and it's where I start, but I do scans, which I may show some on Thinkorswim throughout the day, that help me identify if there's other stocks that I should be considering. As usual, I'll do a top-down review. I'll look at the markets, industries, the stocks. I'll show you a couple of shortcuts. I may or may not use other programs. I always do. And then I may look at a few stocks at the very last of what I'm looking at. Again, Ian and Ron are the secret weapons of HGSI, and have really, they've added their expertise to George's great programmers and Matt to put together what I think is one of the best programs out there, which is why I'll be using it tonight. And every March, and I think it's going to be around the 24th, will be the next meeting if they have it, in Palos Verdes. They do a great job. And here's the website for High Growth Stock Investor, since it's somewhat less common of a program. On the website are links to the blog, the weekend free reports from Ron Brown, and then as you can see, you can get a free trial software, including data feed, and they don't ask for a credit card. On that last comment here, and I apologize if people say, why do I do this all the time? I do it because I invite a lot of folks that haven't been here before, and I've actually streamlined this a lot from what I used to do in the beginning. Where are we in the market? And I'm not sure if we've actually gotten anywhere beyond this red circle. We're clearly not in a rah-rah-rah up move. We're probably living in this period of uncertainty, although if you'd asked me 2 weeks ago, I was pretty certain we were heading down the stage 4 of fear and that we were selling. And I think what we're really doing is living in this sort of this Darvas box. And it may turn out to be, and we'll look at the major indices, that we may be having the 200-day here and the 50-day here, and we may be bouncing back and forth in between them. Frankly, not such an unhealthy thing to do And if we actually paused here, paced, and went sideways and let these indicators, moving averages, start to come together, that gives you an opportunity to sell at resistance, buy at support, and look for breakouts or breakdowns. So again, I think we're sitting in that, as Ian has referred to, Darvas box type of a marketplace. And I think we're still living up here in stage 3. And the interesting thing with stage 3 is you could end up breaking down or turn out to be a pause to refresh and go back up. So I'm going to start trying to figure out how that's changed, where we are this week, and we'll start to look at various stocks. I want to open up EdgeRater because I'm going to look at it in a second. So I'm going to actually start it. For those that have not bought EdgeRater yet, I'm going to probably be more detailed with it next week. They just did some major upgrades, including the in-the-market updating, which they hadn't had before, at least in this product. And I think that's a huge new tool. The other thing is, if you look closely at that, it's an EdgeRater Club. And Chris has come out with a new version. He's trying to build in some templates and some neat things. And I'll go into, again, more next time, but he's now taking it to a monthly. You can now do it on a monthly basis instead of having to buy it outright. All right, so I always do what's called the percent buckets report to get an idea of where the market is. So I'm just going to start here and update my data. It's all there. I'm going to go update. That's going to take a little bit of time because I've got all the securities. So I'm going to shut that down, and let's move forward with. I think that's going fine. All right, let's go back into HGSI and take a look at some charts. Then I'm going to review the performance from last week. Oh, look where that's going. You know, I'm going to cheat and go back to the old version. Sometimes when new things come out, I'd rather play with it before I actually do demonstrations with it. So I'm going to stick with the old version, and maybe I'm not going to stick with the old version. I may not have access to the old version anymore. All right, no worries. I think I've already updated the chart, so let's see. One more time. Home, data provider, HGSI. That's why it was taking long. Okay. And then I want to go to symbol list. I want all of them. I want to update them. And, all right, now it's updating. Perfect. I will come back to that in a little while. We'll open up Excel actually to start. I like to look at what happened in the market. So last week, if I remember correctly, my comments were along the lines that I thought, that we were at a risky market, but the lesser resistance was to go up, and that I thought we'd probably go up, but I was concerned about resistance at the overhang with the 50-day moving averages sitting on top of most of the indices. It was an interesting week and somewhat perplexing. And I sort of bear all here. I don't hide my performance, although my performance is not actually my performance. I look at the stocks that I had in my various portfolios that I control on Monday morning, and I look at a number of different portfolios that I put together as watch lists as well. And I try and see what's working, what's not working, and I compare it to the market itself. And I don't consider any money management. I don't take into account any hedges I might have, and nor do I take into account any transactions I do, buying and selling. So it's really just gives an idea of how good the stocks were that I was holding on Sunday night. Had I held them for the week, which there's no guarantee that I held any of them for the week. So the S&P 500 was up 0.50%. So that's sort of the base of what the market did. Certainly not a very strong market, but there were days of strength and some days of weakness. If you look at my personal holdings over here in sort of light pink, I was up 0.4%, and really about a 50-50, so clearly not a very exciting week. And yes, I'll give myself an underperformance. Last week I outperformed substantially, so it was sort of a catch-up as perhaps other types of stocks rotated into what was being attractive in the market. HGS 100 had a much better week, 57 winners, 25 losers, up 1.25%, about the same, frankly, as the IBD 50. So growth stocks, and the kind that IBD and HGSI picked, outperformed for the week. If you remember the week before, I think it was like 3.75, 4% was how much the move was. So this was a very muted move. If I look at my various buy lists, and every time I identify a stock I'm interested in buying, I put them into different categories. I call leaders extended or gone will be stocks that are in the midst of a great run. They're nowhere close to a recent base. They may or may not have great earnings, but they have been the leaders of the market. Sometimes it's hard to buy these because they may pull back, but this was a great week to have bought the leaders, as they were up nearly 2%. Only 2 went down and 13 went up. I had a list that I called breakouts. Breakouts would be stocks that had pulled back or were right below resistance, and then they broke above that resistance. There were only a couple. They did not perform well. They were sort of flat. Bottom fishing for nuggets. I'll be looking at stocks that really have no business being on a buy list except there's something compelling. Either they had some interesting action at the bottom of a deep pullback. Maybe they've got some fundamentals that make them intriguing. They did not perform. I look at pullbacks. I look for pullbacks that have pulled back to major moving average without a signal to buy, and some that give me a signal to buy, which are the ones ready to run. And they all performed. They all made money, but they all underperformed or did not perform much different than the market. Some weeks they do very well. Now, what was sort of strange to me was the top performing groups all say bears. So in fact, not that I was shorting this past week because I thought the market would go up, but all these came from various scans which I typically use for shorting. So what does that mean to me was last week the rest of the market caught up to some of the leaders that had moved up the last couple of weeks. We saw the coal stocks moving. We saw solar stocks moving. We saw RIM moving. So some of the things that had been hammered were the real leaders. And then this comes from a thing that's called the group performance analysis with an HGSI, which does this automatically for me. And I could actually look through and see wafer is a solar semiconductor. It was up 15%. It was the only one in this group of these RTM7 bears. Nectar, which had gotten clobbered the week before, was up 7.41%. Some things that persons identified as shorts, utilities, as are all utilities, interestingly, all of them had a big move up. And if I look back down on the bottom, I think it's always good to do a post-mortem and understand what was working, what wasn't working. Western Digital and Seagate, for that matter, they may be setting up for something, but I called them bottom fishing last week, and they're still bottom fishing. Safeway and Manny's Pet Boys really did nothing. It's interesting. Some of the bullish searches just did not perform, like bolting relative strength. Ended up 12 gainers, 7 losers, and underperformed the market for the week. All right, so that gives me an idea of how I did, how the market did, and what may have been moving. So let's shut that back down. Let's take a look at within the market now, if we can get a sense of what's working and what's not working. So let's run the percent buckets report. So for me to do that, updated the list. All right, very good. All right, so for those that are newbies to me, I'm going to try and do this again. 'Cause I got to tell you, it took me a while to figure this one out, and now I try and teach it, so I'm sure I flub it. If you think about a chart with Bollinger Bands have a midline. We'll call that the halfway or 0.5. They have an upper band. We'll call that 1.0, and a lower band 0. And I think it's 95% of the action of a stock are going to be confined between the upper and lower bands. When a stock gets below the lower band or above the upper band, if 95% of the time it's inside the band, then you can guess it's going to rebound back into the band. So overbought, likely coming back, oversold, likely going up. If you look at a bear market, the stocks tend to go from that middle band to the lower band and bounce around, while in a bull market, they bounce between the middle and the upper. So you can get a sense of how bullish or bearish the market is by looking at every stock in the market or in an index and asking yourself, where are the stocks? Where do they close? Do they close at the highs of the upper bands, which could actually counterintuitively be a market that's setting up for a correction? Did they all close near the bottom of the lower of the bands where they're going to correct or they're going to move up? So I use this, and it turns out one of the things I do with HGSI is I can take the S&P 1500, which are 1,500 different stocks, and I can break the S&P 1500 into a number of different buckets, and 512 is not where we're at, so let me try that again. Oh, Jeffrey. Run. And so I will run this on a nightly basis, and I'll get an idea. Here we go. Here it is, 11/30/2012. It looks just like the one did from I was sitting here, which is why I didn't notice it. And you could see that 80% of the stocks in the S&P 1500 were trading above that middle band. As I said, in a bullish market, most of your stocks will be bouncing between the middle and the upper band. Only 6% were trading above the upper band, and 1% were trading below the lower band. And you could see the majority of the stocks were trading in the middle, between the upper band and the middle band. So above 80 is bullish. This is a very bullish picture, which would tell me the market is healthy and likely to go up next week without being excessive. Now, we can see back where we came from, and last week on Sunday we saw a number which was 64%, so not as high as the 80, and we can start to see back here that more and more of the stocks are in the middle with a higher number sitting below the 50%. And if you look back to where we had pain a couple of weeks ago, this is what a painful market would look like, where over 80% of the stocks were below the midpoint. And you could see here that over 20% were below the lower line of the Bollinger Bands, or the lower band. No surprise then that the market over the last 2 weeks has gone up, because if you look at McClellan oscillators, almost anything else, you'll find a very oversold market. And this is just one of the tools that I use to notice that it's oversold. So what I will do next week is I'm going to show you how one could use HGSI to determine what your buy and sell setups are, run it against the market, and then do some back testing with various stops to determine what would have been your best plays. And then once you come up with your best play or your best approach, I'll show you how you can at 3:30 in the afternoon, Eastern time, you can update the stocks, run your program, and get a list of at 3:30 what are the best stocks that are working, and actually consider making purchases before the end of the day. Again, maybe not the smartest thing to do in the market we have, which seems to go up and down based upon news, but in a trending market, it's a way to avoid tomorrow's gap up. Now, I always like to get an idea of where we are for earnings as we start this program, and I saw that China, or not earnings, rather futures, I'm sorry, that China had some good news, and you could see the futures have all turned positive at where we are right now. So that turn with China had some positive information, and I think it was their PMI or something closed up higher than expected. All right, so I'm feeling good about the market. Had a decent week in certain scans. Frankly, as much as I hate saying I was only up 0.4% or whatever, over 50 weeks, that's a 20% return, so it's not horrible. I just don't like doing worse than the S&P 500. So let's take a look at some of those indexes and see where they might tell us about where we're going to go from a resistance and support perspective, and see if we can't get any better idea of what to expect in the market. Apologize for that. My dog has decided that he likes something, so I'm going to go off speakerphone until he decides to, well, maybe he's going to be quiet now. So this is a top-down view, which is looking at the matrices. And hold on one second. I'm going to go let him out of the current place. And there must be something that's got him excited. All right, buddy. All right, so I look at the top-down view, which looks at, it's a fairly balanced, but it's all technicals, looking at 1, 5, and then a little bit longer, 2 to 3 week period of time. And it looks for performance and price and volume. And I like this when I look at indices. It tells me where the strength was. Remember I showed you that search, the short person search, which turned out to have predominantly utilities. Well, no big shocker. If you look at the utility average was leading. Interesting to see growth stocks and utilities doing well at the same time. NYSE composite was up near the top as well. On the bottom were gold, silver, and the dollar. So that's actually interesting because the dollar has sort of been opposite of gold and silver in the market. So there must have been something else going on there. Volatility actually moved up. If you look at 5-day behavior, volatility was the leader for the week. So that might be a telling us that this market might be at more risk of correcting than I've sounded so far. It had a big move on 5.4% on Friday. The losers for the week, 2.1% for gold on the 5-day and 2.3% for silver. So gold and silver, which have both had a nice run, each had a relatively tough week. So let's take a look at some of these, look at the dollar, look at the VIX, and then we'll move forward and look at some indices. I always liked the NYSE because the NYSE is giving me a look at just a large number of stocks of different sizes. And it happens to be perhaps the healthiest of the indices that I look at. And I'll show you why I say that it might be the healthiest. And for those that are new to my webinars, certainly it's not my best. I've stumbled a little bit to get to this point. Let me just tell you what I put in my charts here. I have a number of ribbons up here. These are momentum ribbons. The middle one here, where my arrowhead is, accumulation distribution. Green is good, red is bad if I'm long. So I'm looking very quickly at bongos and the force indicator, which are momentum indexes or indicators. The high jump is sort of my extended indicator from Ian Woodward and Ron Brown. When it gets near the top, indices and stocks almost pull back. So I always want to see where I'm falling on the high jump. I have in the chart, as you can see, candlesticks. The purple or magenta is an 8-day exponential. The 17 simple is green, the 50-day simple is blue, the 200-day simple is red. The blue line is a pocket pivot up. The pink magenta line is a pocket pivot down. I have 2 volume bars. These are the same. The reason why I have 2 is because I can't see the volume underneath some of these indicators. The bottom one, and I'm going to close off Force Kahunas for tonight. The bottom one is something called Kahunas, and the Kahuna, I'm just going to go back to the PowerPoint for 1 second. The Kahuna is tied to the Bollinger Bands as well. And what Ian did some research, let's see if I can have the Kahuna here. If I don't, oh, all right. And what Ian found out was that the stocks normally move less than 24% the distance between the lower and the upper on a given day. And that if a stock moves more than 24% up or down, that's a pretty big day, and that's a day to take a look at and pay attention to. That if it moves 50%, that's a really unusual day occurring only several times a year on a major indices or a stock. So we look at the Kahunas, the little and the big one up and the little and the big one down, as additional momentum indicators with HGSI. And we look at one called the Eureka and the Phoenix, which I'll show you in a second, which are our version of the follow-through day. And in a market that has been stumbling, the presence of a Eureka might indicate that there's going to be coming some more power into that market. And an up market, it's very much analogous to what William O'Neill has termed a follow-through day. So, in fact, you can see a number of Eurekas in the market where my arrowhead is. And these Eurekas, almost each time here, have signaled the beginning of a bull run. So we did get a Eureka about 6-7 days ago, trading days, because we had a day off, I believe, for Turkey Day in there. And this was sort of the follow-through day, which told a lot of us that this rally might be for real. The reason why I'm saying that this is the healthiest of the indices is because it closed near the high of the day on Friday, although it's a spinning top, which means I like to see where it opens on Monday. It is above the 50, which is above the 200. And you're going to see that most of the indices are bouncing in between here. As you look above this, I don't see any resistance. Now, I have resistance here from old highs. Probably have some minor resistance here to get across. You know, the old congestion zones often turn into resistance. But everything's green, had a pocket pivot, good volume on Friday. The last Kahuna was positive, it has a Eureka. I'm very bullish, relative to the others when we look at the NYSE. Part of the problem is that's not indicative of the rest. Here's the NASDAQ. So the NASDAQ, deep pullback, and now you get I have to wonder, are we in this phenomenon here where it was range bound between that 200 and the 50? And for this NASDAQ to show me confirmation of being bullish, I need to get it above this 50-day moving average. Note the Eureka here is only calculated on the NYSE, so you can ignore it on all other indices or stocks. But it gives an idea that there's oomph coming into the market. So not much of a day, also a spinning top on Friday. I've got to see this break above the 50 or break down below the 200 to get a good idea of where we're going. If it goes sideways for the week, not necessarily a bad thing. One thing while we're here, if you look back here on the high jump indicator, you could see when it ran up here in September, along the way it gave a number of clues of getting toppy. And every time it peaks here, it either goes sideways or it pulls back. Sort of like that balloon that you pull too far, it's either going to break or you're going to let go and it's going to contract and go back to the center. If I look at the S&P 500, I see perhaps less, we have more of a distance between the 50 and the 200, but I see the same pattern, which is I face resistance above me. Now, good China day, a pop at the open, a gap up gets us above the 50. I'd expect in all these indices then to retest. And if that holds, then Santa Claus is here and we have ourselves a rally. I also think it's possible that we trade right back down to the 200 and then we hope for a bounce there and not a breakdown as we saw back here a couple weeks ago. The Russell 2000 closed right on the 50, so actually a little bit stronger than the last two indices, although not quite as strong as the NYSE. But the pattern is pretty obvious. You have markets with overhead resistance with that 50-day moving average, which to me is relatively impactful. And it'll be interesting to see if these markets can get enough of a lift to get above, retest, and go forward, or are we going to be range bound? I always like to look at the S&P 1500 for a lot of the things I do because it combines the 400, which is the mid cap, the 600, which is the small cap, and the 500, which is the large cap. And you could see the same pattern, which is we've run up to this 50. You see how the 50 acted as resistance here? And when you failed here, as David Elliott would have called, I think, an ice hole failure, you go back and you test the next lower major moving average, which did not hold. We're testing again. We've tested it, I think, 2 days. Can we get above it? Remains to be seen. So, you know, if you want to know what to do Tuesday and Wednesday, is this market positive or negative, I might look at some of these indices and look at how we closed in relationship to that 200-day moving average, or that, excuse me, the 50-day and the 200-day moving average. Nothing fancy about these charts. The dollar and the VIX. The dollar has been not the market's friend. When the dollar goes up, the market corrects. Since the market's been in a move the last 10 days or so, the dollar has been down. And, you know, it wasn't hard for anybody to call this. And if you go back 3 or 4 weeks, you would have heard me say we're going to trade up to the 200-day moving average, and then we're going to come back to the 50. And that's exactly what's happened. So the dollar looks just like those indices, except the 50 is below the 200, which is more bearish. And are we going to bounce back up to the 200? Are we going to break down below the 50? Or are we going to be range bound and bounce back and forth between them? You look at the VIX. It's right in front of me. And the VIX is, it would be hard to call the VIX healthy looking by any means. But the VIX, although it's certainly gotten lower back in the summer, seems to have found a place that it pulls back to a little bit over 15. But until the VIX can convincingly get above the 200-day moving average, which keeps getting lower and lower and lower, I'm not going to be a believer in the volatility until I get a close above that 200. And the VIX really has been range bound between these lows and this 200-day moving average for some time. Now, sometimes it's worth putting more information on the chart and reminding us that this VIX is remarkably low. It is in a zone that it usually gets to and doesn't get much lower than that. If the VIX bounces, that's also bad for the market because it would imply more challenges in the market. And if we look at what we have here, I think you could see periods of time where we could expect the VIX and any instruments related to the VIX to be much higher. So not much volatility, a weak dollar, indices facing some short-term resistance above. I think you got sort of have a showdown here between the bulls and the bears, and I'd be watching that 50-day moving average on the major indices and seeing if it holds on the NYSE and if it turns into support and not resistance for the others. I think that will have a lot to do with where the market goes. So just as I said last week, I'm trending towards a little bullish. Obviously, the Chinese thing is interesting. But as I also said last week, we are right, we're in that Darvas box scenario. And are we going to bounce here at resistance of the 50-day moving average and come right back down to the 200? Or are we going to break above it, see the 17 turn up, the 50 turn up, and go on to test old highs? Bulls would certainly like that. I'll let the market tell me what it does by watching closely the shootout at that 50-day moving average. So I'm going to have a tone towards bullish, but skeptical as I was last week. And now I'm going to try and look at where the money is going on the industry perspective. So again, I use the top down to take a quick look at what's working, what's not working, but that's not what I'm going to use for my sector analysis. The top down looks at, as I said, a 5, a 1, and a 2 to 3 week time frame. So it's including a number of different spots where price and volume mattered. And that's great, but if I want to know what worked yesterday, I want to use something that's much tighter. So I use a 2-day force index, which only has 2 parameters, price and volume. So taking the difference in price times volume, plotting it, and then looking at a 2-day and a 13-day exponential average as taught by Alexander Elder. So there are 145 different groups, and when I go to the 2-day up, I see that we've got 78 that are up, and there's a lot that will be neutral, and we have 20 that are down. So if you look at where the pain is in your portfolio, these are where the pain is. Well, if you had a good week, then it's probably in the ones that were the force up. So let's take a look at the first let me take a look and see what jumps out at me just from a high level view. I see a lot of energy. I see oil, gas equipment and services, oil and gas drillers. I see refiners. I see storage and transportation, exploration and production. My weekend review starts with about 8,000 stocks, a number of watch lists, searches, and scans, which brings it down to about 300 stocks, and then I flip through them, and I get an idea of what the market's doing, where's the strength, and where I might want to be trading. Something I got to get over with, by the way. It takes a long time. And there are certain themes today. There are a lot of regional banks, a lot of thrifts and mortgage finance institutions. Not surprised it was number 2. The big banks didn't make my list, but their volume is so high. If they trade up for the week, they're on this list. If they trade down, they're on the other list, and I'll show you why in a few minutes. A number of oil and gas plays, including companies that have been toast for a long time, like PTEN, several of the drillers, deep water drillers. Haven't seen them make it to my list. To get on my list, they had to pass a lot of different fundamental screens and some technical screens. So I thought that was interesting. Housing stocks seem to have taken a step back. As you saw, they were the worst performers. So that I always try to get that feel. Didn't see a lot of technology plays that were working. Saw a little bit of retail, but the ones that really stood out and surprised me were the number of energy and the banks. So let's take a look at a couple, maybe the first. I'm probably not going to spend much time in utilities, because when the utilities are working, it's time for me to usually go do something else, because they usually go counter to the type of stocks that I buy. So let's start with the pharmaceutical index. So I right-click on this, change the index group, and it shows me where the strength is in this group. Last week we looked at several of these, and I'll take a look at them right now. There are some here that I find interesting. I like the chart pattern on SLXP. I love the numbers on Jazz. And I recently bought Abbott. We'll take a look at that. There's a lot to like in this group. So why did I buy Abbott? And we talked about it on this program. We bought Abbott because Abbott is a perennial leader from a performance perspective. It's a safe investment, not that that's what drives anything that I do, it seems, but it pays a nice dividend, 3%. Don't make that in your bank accounts. But I bought it because here was a stock that had respected its 50-day moving average and then had a rip-roaring pullback down to the 200-day moving average. And I consider this a low entry point, and I bought it somewhere down here on the 200-day moving average, hoping to ride it up to the 50 and maybe beyond and collect some dividends while it goes. And stock has performed. It's moved up off the 200-day moving average. It had a big kahuna. This is the industry. You can see the strength of the industry. Here was my high jump bar where you could see it got too high, it pulled back, it got too high, it's had a deep pullback. So it's nowhere close to being high. I like this one a lot, not because it's a great growth stock per se. I like it because it pulled back to major moving average, gave me a kahuna, would have loved a pocket pivot. That's another thing that I look for, and I jumped into it. I jumped in when most of my momentum indicators were red, and that was a little bit worrisome, but I figured that I had a low risk entry down here, which is why I jumped into it. J&J, Lilly, Pfizer, they all have something in common, and that was, again, great companies historically, big companies, paying with big institutional ownership, but paying nice dividends. So Pfizer, Lilly, Merck have all been near the top of the list in this market. Dividend plays have performed well. Now it'll be interesting to see what happens with dividend stocks going forward with the higher taxation that may be coming, and also how many of these come out with supersized dividends before the end of the year for tax advantage status. If you've been watching the market, every time that happens, even on stocks, I saw $3 stocks come out with dollar dividends. Everybody's trying to get cash out now, especially when there's heavy insider ownership, so they can take their dividends out at a good capital gains, and then they'll probably have to take debt in some of the cases. You could see on Pfizer in an uptrend had pulled back, didn't get down to that 50 days like Abbott did, or that 200-day like Abbott, had a pocket pivot, a kahuna here, starting to turn green, certainly a great company, and historically a great stock. It's not been the greatest of stocks of late, but really looking at since December 2010, on a weekly chart, it has moved from the lower left at about 16, 17 up to 25. So about a 50% return plus a 3%, 3 to 4% annual dividend. You know, there's a reason why a lot of people like these and call them mattress stuffers. Salix, don't know much about the company, but I kind of liked what I saw here. I actually owned the stock in the past because there was a time that it had very impressive earnings per share growth, and I'm an earnings junkie. Those that have worked with me closely know that that's probably what I like to see the most. I hidden, the bongos have a bongo weekly and a bongo daily, and I like to buy stocks where the weekly turns green. And typically, the weekly stays in the direction of the market. It's late changing, but it keeps me out of stocks that I don't want to be in. Because the weekly is slow, I actually have a fast weekly, which has already turned green on Pfizer, as have my Elder Force indexes. Pocket pivots, excuse me, on Salix, 2 days of kahunas came into it. I see a relatively low-risk entry where I could put my stop around 40. I'm likely to get into the stock at 43. I might put my stop halfway up, maybe at the 50-day moving average, if I don't want to put $3 at risk. But I think this thing can run up to its 200-day moving average where it's going to face some resistance. Now, if you are an options player, you could look at doing some spreads, maybe buying a call in the money or close to the money and selling something at $48 because it's going to face some resistance there. But I like this pullback pattern. It's had a chance to heal a little bit, and these pocket pivots, then the kahuna, now above the 50-day moving average. I find that one attractive. I started to mention Jazz last time, and then I backed away because it's not really a true growth stock anymore, and it had pulled back pretty deeply. Its earnings per share growth is pretty outstanding. If you look at it going forward, it's accelerating. It's got overhang with a generic drug going through the courts, but a lot of analysts came out last week and basically started downplaying the risk and price targets of $70 and above. It's got earnings power, some of the best earnings power of any pharmaceutical company out there. It's got products on the market. Its risk really is the generic coming in earlier. And there are things about the generic, those of us in healthcare know what a REMS is. It won't be easy to bring a generic out, and as the analysts have gotten favorable about it, I think you'll see this continue to move up. Watson is another stock that I like a lot, and one that perhaps is going to continue to be a leader going forward. In fact, this one's worth pulling up Market Smith. Take a second. I use a lot of tools. I use too many tools. I try and hide my desktop during these programs because the tools can become a distraction. But one of the things, as I said, I'm an earnings junkie, and HGSI gives me 2 years back and 2 quarters forward of earnings. I like to get a better sense of what's going on. And here's one of my bottom fishes, which we'll talk about later. Big pullback down to $5, was an IPO back here, traded up as high as $18, makes money with some decent growth, and I liked it because it looked to me like it had put in a bottom back here. So we'll talk more about this stock later. That's not Watson. I wish I could buy Watson for $5 a share. Look at the earnings per share growth. I mean, how many stocks in this marketplace outside of the builders are growing their earnings to this degree? Trades at a multiple at a discount to its earnings growth rate. A lot of funds own it. Certainly in an uptrend, one can look at the weekly, a very steady uptrend. Even if it doesn't get any respect for its increasing growth rate. All right, $8 a share times, say, 20 of a multiple, which would be half of its growth rate, would be a $160 stock. $8 a share times 14 will be a $112 stock. All right. The stock trades for, it's pulled back a little bit, trades for $88. Everything has turned green, and this is a stock that I love and a stock that I'd be looking to add to this week as well. I come from this industry, so I spend a lot of time here looking at pharma and biotech to see if anything else pops up that I might be nibbling at. I mean, I'm not a, J&J, Pfizer, Merck, Abbott. You can have some of these in your portfolio. They're not rah-rah, cha-cha-cha growth stocks anymore. As I pointed out earlier, they all pay some nice dividends. This pays 3.5%. All of them that pull back, this pull back to the 50, a pocket pivot on Friday. Looks like it might run again. It's at a low-risk place to buy. Pays a nice dividend. A lot of people like J&J. Thrifts and mortgages. I don't know most of these companies from Adam, The only one that I'm in right now is OCN, and then one of the managers who manages my money is in Annaly. A lot of these things, and actually I bought Flagstar last week, so I guess I didn't realize it was in this group as well. So these things also have some earnings power. So let's take a look at some of these. And it's interesting, many of these make their money by buying up the same types of mortgages that caused the marketplace to collapse in the past. So the poorly performing, over-leveraged, poor quality loans, these people buy at a deep discount and they get some performance out of them and they make a lot of money. I don't know Everbank from Adam. Nice run up, pulls back to the 50-day moving average. Why is there no high jump? Because you can't be an IPO and you got to have a 200-day moving average to give me a high jump. Pull back to the 50. Something happened to this stock on Friday, pocket pivot, huge volume, bullish candlestick taking out the 50 and the 17-day. That looks very attractive. Pays a dinky dividend of 0.5%. Walters, similar pattern, been around a little bit longer. Let's go into MarketSmith and take a look at what they show for earnings growth, because I can't remember. This was the point I was going to make. Massive earnings per share growth anticipated. The one that I've been liking for a long time on these calls, which has also got the same pullback pattern as OCN. These stocks have massive earnings growth, subprime, non-conforming, other credited sensitive residential loans. So they're buying crap, frankly, and they're making a ton of money. Huge earnings growth, pulled back to a major moving average, pocket pivot, a kahuna, no dividend. What's not to like if you're looking for a growth stock? Except I like dividends too when I can get them. Very interesting looking there. Home Street, a little bit better looking from the perspective that it had, it's breaking out to new highs. High jump tells me it's a little bit extended, but I've got a very little period of a high jump because I just started getting a 200-day moving average, which means this is probably another company that came into the business in a recent time. Kahuna, massive volume, pocket pivot on Friday. When you start to see so many in a sector with the same picture with the pocket pivot, something's going on with this sector, and I probably want to get interested in here. Don't know this guy from Adam, NRF, pays a 10% dividend. Pull back here at 200, it's taken off again, had a pocket pivot, gap up on Friday, traded down within the gap, and closed at the high of the day on Friday. Kahuna on Thursday, pocket pivot on Friday, everything turning green. NRF, just curious if it's got earnings when I step out further. And, it makes money here. It doesn't make a lot of money, but for a stock that's trading at $6.73, and $1 of earnings is a lot of money. Back to my charts. Annaly, as I said, one of the guys that manages my money has it, and he's recently bought into it because of this 13.6% dividend. He does weird strategies with calls and puts, never really takes much of a risk on the stock price, and tries to make money on the dividend on this play. Stock looks like a dog compared to the others, so I'll have to call him up tomorrow and yell at him. Here's the one that I mentioned last time, and I hope people bought this stock. This was, I don't think I say stock of my day or stock of the week. This was one I was profoundly interested in because of its earnings. So this is FBC. So profound pullback, new CEO, RS of 99, certainly in an uptrend here. Goes from a massive loser. You see monies like this because it had a reverse split of 10-to-1 reverse split, which typically doesn't work. In this sector, they seem to have worked. Turned it around on an earnings perspective. makes a ton of money, trades at a multiple of about, well, 12 here, but if it meets, if it trades 12 times 353, that's $42, and the stock is currently trading at 18. So here's a stock that has, I think, still a lot of room to run. Last week, Friday, Thursday, Wednesday, Tuesday, Monday, you could have bought the stock at about 16.5, and you'd be up close to $2 already on an $18.5 stock. Pocket pivot on Friday, tons of volume, still looks like a nice thing to jump into. Interesting group of stocks. A lot of them made it on my list this week. And, it's a funny sector, but talk about sector influence. That entire sector is moving. Something's going on there, and you might want to be playing a little bit. Internet software and services, Google, deep pullback. Sometimes these things work so well. All you need is a scanner going real time in the market to let you know when it actually happens. But I don't love the Google's earnings per share growth. It's clearly decelerating. Pull back deep to the 200-day moving average. Has bounced. We'll see if it can get above the 50. If it does, I expect it to continue going up, but I wouldn't touch it between here and there because I think it's going to face some resistance there. eBay, I'm going to look at eBay on MarketSmith. Everything has turned green. It's moved up off of its 50. Not at the top on its high jump bar. You compare the last sector we looked at and what the earnings looked like there. And now we look at this sector. Names we're much more familiar with, probably a lot safer, and the earnings per share growth is much more muted. So where you were buying those stocks at a discount to the growth rate, meaning the price to earnings ratio was half the growth rate, here your growth rate slowing down to, I guess it's increasing from 7 to 17%, and you're buying it at a multiple of 23. And if you look at the longer term multiple on eBay, you can see that it's ranged from 6 to 23. So you're buying it as expensive as it's been, and its earnings per share growth clearly has slowed down, although maybe short term it's picking up. So not rah from an earnings per share growth, but neither Google or eBay qualify for that, but they're both in nice uptrends and nice looking charts. Close this down. What else have looked good? Oil and gas equipment, as I mentioned, I saw a surprising number of these. How much of a dog is this stock? It got clobbered, Halliburton, in relationship to what happened with British Petroleum and their, was it Horizon, I think it was called. And it's been in a horrible downtrend. We go to a weekly so we can see what I'm talking about. Living down around its 200 or 1,000-day moving average. It was a $50 plus stock. Is there any reason to think that hope is coming? Well, got above all of its moving averages here. God, this is exactly what I like to see the major indices do. On a pocket pivot, everything has turned green. Now, when I look at Halliburton, and I think I've already started something here looking at earnings going forward, I think you're going to get to a point where they're going to start to anniversary some of these rough times. And if you start to see earnings per share growth coming into this, it is trades at a multiple of 10. It's had a multiple as high as 30 in the past. That maybe, and again, I'm not advocating you buy this because it's a stock that, when you put on that weekly, it's pretty clear it's been in a downtrend for some time. But it's interesting to see that it makes this list. It also made my list that I looked at in the week. As I mentioned, a lot of these oil services stocks and drillers made it to the list. Schlumberger, Weatherford, totally different pattern than the earlier stocks we looked at, and these were ranked number 3. But you can see in this line here, which is group index, that the group is really behaving nicely. Like here's Key Energy Services. I call this bottom fishing. Now, you've been in a basing formation. You had a pocket pivot on Friday, 2 kahunas, big volume on Friday. Everything has turned green. It makes money. It trades for $6. Let's see. I think it closed at like $6.60, $6.70. Closed at $6.69. 200-day moving average is at 10. That's a 33% move to get to that. You know, I call that a bottom fish. I have a speculative part of my portfolio. You saw that other one come up earlier, but it's something that I might look at. But not because it's a growth stock, because it looks like you can get it cheap. And if you can get above this 50, you might have a run up to that 200. The drillers, as I mentioned, saw plenty of these. Now this one looked really good, ESV. I think this is a XUS driller. So it's been basin from left to right. And this is a pattern that I love. Had a big run up here, and it got up to the top of its high jump bar. And so rather than pulling back, it just has essentially gone sideways. I'm going to give it a little liberty here, to the point now where it's nowhere close to the high jump bar. Everything has turned green. It makes money, had a pocket pivot, had huge volume come in, pays at 2.6%. Well, this is a stock that then moves to my list of potential buys. And I would call this a stock that's pulled back, and now it's ready to run. It was the best of them. I mean, this is a stock that I know well. It's really been a dog. And it's been in earnings hell. As you could see, all these minuses the last several quarters. And you could see that it's actually moved up above its 50, above its 200, had a little of a shooting star on Friday, so it may have some risk of selling off this week. Multiple pocket pivots, good volume on Friday, everything is green. So I think what this is telling me is that we're starting to see a really change in this industry, and it's probably worth taking a look at these. These have not been great performers. Its range of multiples between 4 and 60. It trades at a multiple of 8. You could see its earnings. It makes money, but certainly trending the wrong way. So I'm not advocating that growth stock investors buy it, but I think it's telling me something is going on in this sector. Probably another 20 minutes for those of you wondering how much can I actually speak in one night. Communications equipment. I'll look at RIM. You know, RIM is one of these junk off the bottom plays, and it moved from a low here. If anybody was brilliant enough or risk tolerant enough to have bought on the bottom and got out of it on Thursday, 45 days, almost 100% return. Junk off the bottom can be very rewarding. You can see that it had 2 sell-offs last week. Ran up Monday on Monday. Tuesday it sold off hard. Wednesday it seemed to put in a stopping power, gapped up on Thursday. Couldn't hold it. Sort of a doji on Friday. Can go either way. All green here. Not making money. The interest here is probably related to BlackBerry 10 that was announced. If you don't believe me that this has been a troublesome stock to own, it runs from a high of about 70, but these are the types of stocks, the PTEN, these, some of those thrifts that really had moves last week that are why some of those bearish searches actually, interestingly, were leaders. Semiconductors, all right. One of the first rules is you got to highlight it, then right-click. Big move on Friday by First Solar. I mentioned there was some strength in solar. These are stocks that have been hammered. In fact, we looked at wafer was another, but you could see from 150 down to 22. Now, You look at just the right side of the chart, you're above all your moving averages. Your industry group has turned up. Everything is green. You've got earnings per share growth coming in. Is First Solar gone from a dog to a buy? It looks very interesting to me. What do I like to buy? I like to buy growth. Here's my growth and earnings. I like to buy stocks that have pulled back to some major support. Well, it's been in major support now for some time, and it's giving clues of breaking out. Now, the time to bought it obviously was a week ago. You can see it's getting up higher on the high jump bar. This is something like RIM, the time was by a week ago. I'm going to watch this one closely because this was at one point a darling of the market, and no reason to say it ever needs to be a darling again. But it's broken above the moving averages. You got the 50, excuse me, the 200, the 50, the 17, the 8. Price above that. Everything turned green with earnings per share growth. That's an interesting looking chart and one that I might be nibbling at. If you look at Skyworks, deep pullback, pocket pivots, kahunas, starting to turn green here. Not as much earnings per share growth. But if you look at this on a long-term chart, like First Solar, has been clearly in a bear world, pull back to major support here at about $20. So you're buying it at about 15% above what has been major support. That's a 200 weekly or 1,000-day moving average. All right. Those thrifts look the best of what we've seen, don't they? Diversified banks, these guys, these are not the major banks, but again, showing the strength in the financial sector. I'm not going to spend much time on these, but you can see the banks made the list. Healthcare equipment. St. Jude, which has been in some difficult times, had some good news come in on Friday. So could be setting up a J-hook and a run of 5 points up to these moving averages. Don't really know much about this company, not much in the way of earnings per share growth. Clearly in a deep pullback. Edwards Life Sciences had bad news here, pulled back, been basing now for about 6 weeks. Had a big kahuna, got some moving averages above it, which would be probably resistance. Does make some money. I don't know much about this sector. I know that this sector is not treated well with the ACA, previously known as Obamacare, as there's a new tax placed on them. Utilities. Now, I'm not a real smart person when it comes to REITs, and thus I don't own many REITs, although some of the guys that manage my money, they may have some REITs. REITs, there were a lot of REITs that had some nice moves of late. And what you might like about the REITs, and they probably do well as long as the market, the interest rates are so low. But here's one that had a pretty deep pullback, moved up on a pocket pivot, got above the 50 to 200-day moving average on Friday with a kahuna, tons of volume, a pocket pivot. Everything's starting to turn green, great earnings per share growth, dividend of 4.5%. Don't know this thing from Adam, and frankly, as I said before on calls, I don't know how to buy these things. But I know that as long as interest rates are low, if I can buy these things at a good time, then it might be something interesting to do. I like the interest rate. I like the pullback and what it's doing right now. I just don't know enough about this company and others in its sector. Earnings rate, growth rate's not that exciting. We're seeing a lot of, not a lot, we saw a couple of stocks change from stocks to REITs, and they have some really great favorable tax status. So if one of your companies makes that plunge, you're going to get some nice stock price growth. I'm just going to look real quickly so anything else pops up. Yeah, I'm going to look at refiners, then I'm going to look at the downside and get ready to wrap this up. Refiners, as a rule, going to all have the same chart. And they've all had some shallow pullbacks. They've got some big earnings coming in. This is Valero, that's both a gas station and a refiner. Pullback, a sort of a saucer. Pocket pivot on Thursday, great earnings per share growth. They all trade at single-digit PEs, pays a small dividend. Like that one. I own Western, and it's at pretty much its highs of the longest time. Now, their earnings, one of the problems with these stocks is their earnings per share growths are very spotty. They're tied to things that we can't control, like the weather. But you can see, obviously a nice performer here. Maybe not the one to buy today because it's already made its move. You might look at Tesoro or DK. We'll look at those real quick. Kind of like Valero, sort of that shallow saucer pan, great earnings per share, everything green on Tesoro. And then DK is another one that's had some great earnings per share growth, although it's bouncing around now. Sort of a flat pullback, basing, and I think these all are about to run again. Pick your poison in the refiners, I like them. So once I've looked at the longs, I take a quick look at the shorts. As I've said, I'm not a big fan of shorting per se. I don't mind buying puts, but I really prefer to buy contra ETFs, either sector-wise or market-wise, when I think the market's going to roll over. But I know a lot of people do like to short individual stocks. To me, the key is to know when to go negative on the market, and you can do it with individual stocks, options on individual stocks, or the contra ETFs all make sense. Home builders had a rough week. They've done this every couple of weeks now. They still got great earnings per share growth, but they get a pullback and then they snap back up. It'll be interesting to see if they bounce off the 50 and have a good week, or are they going to fail the 50 this time and track down to the 200. Based upon their earnings per share growth, I'm a big fan that they're going to bounce, but as Friday came in, all these have pocket pivots down on volume, starting to turn red. Some of these are getting long in the tooth on the uptrend, and perhaps they're due a pullback. We'll have to watch what they do this week. I'll look at biotech, and then we'll switch to something else. So if you watched my webinar last week, or the week before, or maybe even the week before that, you would have heard me tell you to buy Regeneron. And this, like OCN a few weeks ago, like that FBC, this has been one that I've been very bullish on. Friday it corrected, but had you bought it Monday, Tuesday, Wednesday, Thursday, Friday, last week, you would have made just a little bit if you held on to it. If you had bought it the week before, you would have made a ton. And had you sold off Thursday, when you opened up down, you would have made some money as well. This has been a big cha-cha-cha leader. I think it continues to lead. It trades at a high multiple of 80, but at a growth rate that is phenomenal. I know the company well. They're on a high right now with a number of recent approvals. Most of their drugs are marketed through different relationships. We started talking about it when it pulled back. And that's really when you want to buy it. It's getting extended right now. But you look at this, the stock's worth $200 or more. It is going to slow down its growth rate, and a lot of these companies become superstars when they go from negative to positive. And with those approvals, that's why it's making its change. Market cap's pretty big, but it has a lot of earnings growth. So this is a time to be long, and as it starts to slow in the next couple of years, I'd want to be out of it. Pharmacyclics also had a recent sell-off, but it had a pretty decent week. Pocket pivot down on volume Friday, so it remains to be watched. Then another one that's been one of my favorites that I'm currently out of, but I'm not sure for how long I want to be out of. Affymax pull back to the 200-day moving average. If this market goes up, the stock will go with it. It's got a recently approved drug. Doesn't make any money yet, but there's a lot of excitement there. And if you can buy it off the 50 and get a little bit of run, it's probably a low-risk entry point. All right, I'm getting hoarse. So that's how. This is what I do. Now, do I do any shortcuts? Absolutely. So let's look at some shortcuts and then get ready to say goodnight. So in the program under Smart Groups are a number of pre-done scans that are done for you every night. And if you don't really want to take the time to do the things that I just did, look at the market, look at the sector, and work your way down the various stocks. You can go into HGSI strategies. You can look at things like Morales and Catcher and see which things had pocket pivots on Friday. So we get a list of all the pocket pivots. So if you're a pocket pivot believer, it's an opportunity for you to perhaps get in on these. Or I like to look at Woodward and Brown groups, and there's a number of groups that I like a lot. So I may just look at best criteria, and several stocks that I like are on this list. Now there's a trick called group inclusion filter, so I'm going to show you that one right now. If my assumption is that if you were a pocket pivot stock, then that's something that's a positive thing I want to look at. And I know a lot of these stocks here. Here's that Walter investment that we looked at. If you were in Woodward and Brown, best criteria, this is a good stock list. So if you're on a lot of these good stock lists, then if you're on a whole bunch, are you better than if you're only on one? So can I do a search that tries to quantify and identify those stocks that are on multiple lists? And that's called a group inclusion filter. So I'm going to go into my designer, and I'm going to open up group inclusion filter. I'm going to clear. Then I'm going to go up here in the smart groups. I'm going to pick 5 or 6 of them. I'm going to pick pocket pivots, and I'm going to pick best criteria, ERG 240, growth, HGS 100 leaders, quarterly EPS strength, and strong EPS relative strength near 52-week high. We're going to make a group from list. We're going to call it AAA Web Gem 12.2.12. I want to look at the top 8 stocks. So these are the stocks that made it to the most groups. I'm going to hit OK. I'm going to just hit anything here. A couple things are going to happen. These are the stocks that made it to the list. So these are the different groups they were part of. Then if I go back to my HGSI, I'm going to find in the designer here's my list. So these were the stocks. Let's take a look at them. And now I'm going to show you some of my buys that stood out and say goodnight. Prestige Brand Holdings, this made my list. If you look at it, it's a pharmaceutical preparations. Been a very nice mover. Getting a little bit long in the tooth. Everything is green. It makes money. I'd rather buy it down here on the 50 than where it's at today. You can see what happened when it stretched too much on the high jump. It pulled back. It's kind of high. So it's probably too far going. Virgin Media, we talked about this in the past. Lower left, upper right, very nice pattern, continuing to go up. Again, you want to buy this when it pulls back. Everything's green, makes money. 2 quarters out, that means we don't have data. So I jump into something like MarketSmith. I type in the VMED, and I see if I can find anything, and I see, wow. Now I know why this company's going up. Look at the earnings per share growth rate. Huge. Nice pattern, multiple 25, market cap of $9 billion. Don't know enough about it to say I'd buy it, but a pocket pivot. This is a leader, extended. Everything is green. I'm nervous about it needs to pull back. I love its earnings per share growth. This is the kind of stocks I like to buy and hold on to. It was the kind that performed well last week, obviously. Ulta Salon, this is a retailer that's it's a pricey stock, about $100, had great earnings come out, gapped up, big volume, big kahuna there. Everything turned green. I don't like where the earnings are going. It's something worth taking a look at. It's certainly been a leader in the market. We talked about Regeneron already. We didn't talk about this financial, but what a nice run up here. Again, a little bit extended for my taste. Don't like the earnings per share growth. Pays a dividend 2.3%, but we're looking for leaders. That's clearly a leader. AZZ is one that made my list. Everything has turned green. Pocket pivot on Friday. A little bit of volume. Had a kahuna on Thursday. Earnings per share growth coming in. I think they also reaffirmed their earnings. In an uptrend, pull back to support with a pocket pivot going again. Kind of stock I like to buy. Avis budget looks a little bit extended, although the pocket pivot's not all the way up. Or the high jump, two pocket pivots. Everything is green. Don't see much earnings per share growth, so I always like to check a different source. The purpose here is not that these are all stocks that you can go out and buy, but how just a couple of quick steps that I can do to find potential leaders in the market. I think on that note, I've shown you a lot of stuff. Just look at my buy list, and then I'm going to say good night. So I get my list. I cheat on the weekend, in which I do as much bottoms up as I do top down. But I try and find 30 or 40 stocks that look interesting to me. We looked at Flagstar. We looked at Prestige Cooper Tire. We looked at last week. Big run up, kind of loose, all green, great earnings per share growth, a pattern that I like. It's got a MACD divergence that's negative, which tells me it's probably going to pull back, something that we can talk about at another session. There's that Watson, there's that Ensco. Medivation is another one of these biotechs that I like. It pulled back to the 200. We talked about buying it down here. Moved up above the 50 with a pocket pivot on Friday. It's got a recent launch of a drug like Affymax. It'll be a while before it makes money. I like it a lot. Good place perhaps to buy. There's that AZZ. There's the Salix. I talk about bottom fishing. I'm not advocating you go out and buy this stock, but when I see a couple of kahunas and a pocket pivot come into a stock that's this cheap, that's been this beaten up, I go to MarketSmith. This is the one that I think was there when I turned on my computer, SYNC, and what does it show me? It shows me a stock that broke above its moving average here. It's got earnings coming in. It trades at about $6 or so. I'd have to learn more about it. I don't buy a lot of stocks like this, but I like some speculative things in my portfolio. Here's that OCN that I told you I liked a lot, pulled back to the 50. Had a negative pocket pivot here, but on a day that closed on the upper part of the prior day, I'm not sure that that's a big problem day. Great earnings per share growth, and a stock that I'm very interested in. There's my friend George Lee. Many of you probably were listening to him tonight earlier. At this point, I think I'm going to say goodnight because my dog needs to go for a walk, and you probably are tired of hearing my voice. Again, I think that you've got to trade the market that you have, not the market you think you should have. And I guess I'll leave it with this picture. It looks like we're sitting in this with the 50-day above, the 200 below on most of the major indices. If you see some gap ups on Monday and Tuesday, and we get above that 50-day, expect a test. And if you test that and bounce up, then this market is going to rally into the holidays. I'm starting to get more believing that there's going to be some type of a deal done, at least on the middle class. And I think that will avert most of the perceived problems related to the cliff, and that will give some opportunity for us to get some Santa Claus time. So everybody have a great week. No guarantees in this market, and certainly this market, there's a lot of news can drive this market down. We'll see you next week. Thanks, everybody, and good night.